Introduction. Before purchasing a stock, ask yourself how volatile it will be. The volatility of a stock can be determined by checking its beta. Less volatile stocks have a beta that is less than 1. Past performance may not affect future results. However, there are historical patterns that will continue. If a stock has a history of consistent earnings and profitability, this trend is likely to continue. While doing research, be sure to check the history. These common mistakes can cost you a lot. Purchasing penny stocks. Stay away from stocks that do not trade on the New York Stock Exchange or NASDAQ and those that trade for less than $5. Relying on rumors. Do not buy a stock because people say that it is about to do something. Do your research. Using margin. Margin is borrowed money. As a beginner, stay away from it. According to Warren Buffett, you do not need impeccable business insights, inside information, or an unusually high IQ to become a successful investor. All you need is the ability to control your emotions and a sound intellectual framework. If you talk to any veteran investor, they will tell you that a plan of attack is very crucial. Coming up with a plan is a little easy. What is difficult is sticking to it even when things are against you. In this book, you will understand the importance of a plan and the implications of not having one. You will also learn the factors to consider when creating a plan and the best investment vehicle options for you. If you can stay the course despite what everyone else thinks, forecasts of analysts, and prevailing trends, then you will have a better chance of growing your investments. Financial markets are, by nature, volatile. There have been so many ups and downs over the last century caused by new technologies, inflation, business cycles, recessions, and interest rates. The 1990s, for instance, were great because of increased use of computers and decreased interest rates and inflation. However, 2000 to 2002 was not a great period. There were so many corporate accounting scandals and other issues which led to a weak market sentiment. When the environment is this shaky and fragile, it is important to have your emotions in check. Do not deviate from your investment plan. This allows you to focus on the long term and have a more objective view. These sins play off 3 primary emotions: greed, fear, and hope. Fear makes you sell too low. You freak out when the prices plunge and sell without giving it much thought. In times like these, go back and check your original reasons for investing in a company, whether they have changed. Hope should not be your main motivator. When investing, focus less on past performances and more on the fundamentals of the company. Greed makes you stick on to something for too long for some extra points. When you hold on for too long, a huge gain can easily become a loss. What do you hope to achieve? There are 3 primary categories of investment objectives: growth, income, and safety. You always hear people say that investing in the stock market is a wise thing to do, but how exactly do you do that? Here is the ultimate blueprint for complete beginners. Who can invest? When someone mentions investors, many think of Warren Buffett and other affluent people. That may have been true in the past. Most people did not have the time or money to commit to the stock market. But things have changed now, thanks to the internet. Anyone can become an investor with just a few dollars. Even you can start today. There's a lot of bad news all over. You can barely find anything positive to read about the stock market. This could possibly make you think that you should wait for a better time to invest. Instead of focusing on the loss of value by stocks, think long term. The stock market gives a return of 10% on average. The exact number will depend on the type of stock, and it varies by year. For better returns, you should continue investing and diversify your portfolio. Time is your friend. Compound interest. The sooner you begin investing, the more money you are likely to earn. So if you are in your 20s, this is the perfect time. Do not worry if you are older, you could still benefit. Stock prices are falling in this COVID-19 era, so it is a good time for great deals. If history is anything to go by, and it is, stock prices rise after a crash. Younger people should investigate long-term investments like stocks since they are far from retiring. Older people should avoid the risk and go for safer investments. Which type of investor are you? Do not invest if you do not have a long-term goal. A robo-advisor or hedge fund manager would be helpful for people who do not know where to begin. If you are a DIY or do-it-yourself person, find a stockbroker and get to work. A group of similar investments is known as an asset class. You can either invest in a single asset class or several. Mixing asset classes is known as diversification and protects you from risks. Basic asset classes include precious metals and commodities, cash, futures, stocks, bonds, and real estate. This is the part where you determine your financial goals. What are you investing for? How much do you need, and when will the event occur? Here are some popular strategies: peer-to-peer lending, real estate, growth, and buy and hold investing. A budget will help you save for investment. You do not need anything fancy. A paper and pen or spreadsheet will do. Investment expenses. Mutual fund loads, commissions, etc. can greatly reduce your returns. Find an investment type with little or no fees. What next? Luckily, you do not have to walk this journey alone. Sites like Investment Junkie have services for both the DIY investor and passive investor. All you must do is choose the service you want. Fidelity offers a range of knowledge as well for beginner investors. You hear stories of how a startup company made it big and generated great wealth for its investors. Investing in companies while they are still young can make you wealthy, but according to many people, only the wealthy can invest in startups. It does not seem like an investment for the average citizen. However, in 2012, the Jobs Act, Jumpstart Our Business Startups, was passed, making it easier for the average investor to get into startup investing. It relaxed a few federal securities regulations, making it possible for companies to get investments via crowdfunding. In 2016, the Securities Exchange Commission voted to allow regulations that made it even easier to crowdfund. Do not get excited and invest in any startup you can find. You should know that many of them fail and investors are left with nothing. Like any other high-reward investment, it comes with high risks. In some cases, you are guaranteed to get your funds back if the business fails in raising enough funds, that is, if they promise to return the money. Note, with startup investing, the shares are not tradable. You must hold on to them until the company is acquired or goes public. Even though regulations have been relaxed, rules have not been eliminated. Because of the risks involved, there is a limit to the amount you can invest in a 12-month period. This limitation is set by the SEC, the Securities and Exchange Commission. The limit is dependent on your net worth and income, so it could be worth $107,000 or $2,200 or anything in between. If you have limited funds but would like to invest in startups, here are platforms that can help you. SeedInvest is a crowdfunding platform that lets people invest in pre-screened companies that show potential. It is not easy for early-stage companies to get accepted into SeedInvest. In fact, they only accept less than 1% of the requests. As of now, they claim to have funded over 150 companies successfully, and they say that they have over 250,000 investors. After signing up, you will get a list of startups that are seeking funds. Most of them accept any investor, but some only allow accredited investors. Wefunder. Wefunder aims to fund over 20,000 early-stage companies by 2029. To make this goal possible, they accept little investments, $100. The average investor can now invest in a wide range of businesses with Wefunder. Investors can buy stocks on the platform with or without dividends, and they can also purchase debt and convertible notes. The money you invest is put in escrow. If the startup raises enough funds, they get the money. If not, you get the money back. In the Republic, you can invest as little as $10. They employ a 4-step screening process to assess the proof of growth, mission, product, and founders of a firm. It also has a platform where investors can discuss. Finally, in micro ventures, you can get started with $100. They have a wide range of companies that you can invest in. They are very selective about the companies they accept.